So about 30% of my entire dividend stock portfolio is made up of my top 5 biggest holdings. And in this video, I'm going to share with you which stocks those are and why I have so much invested in them. So without further ado, let's get into it. All right, my friends, what is going on? It's so great to see you guys. My name is Ryan Williams, and here we strictly talk about dividend stocks and how to invest in them to build a steady stream of passive income that someday will hopefully allow you to quit your job, retire early. That is the dream, guys. And if you keep chipping away at it and contribute to your portfolio every week or every month, little by little, just keep buying those dividend stocks. At some point, that dream is bound to become a reality. At least that's how I look at it. Anyway, before we get rocking and rolling and talk about my top 5 biggest holdings, first, I want to hear from you guys. Leave me a comment below and let me know what are the top 5 biggest holdings in your portfolio. I'd be very curious to hear if we have any of the same ones. Anyway, moving on, let's get into the main event. The 5th biggest holding in my portfolio is AT&T, ticker symbol T. Now, this was one of the very first dividend stocks I ever bought. And if you go back to one of my very first videos on October 17th, 2020, you'll see me talk about AT&T there. And at that time, I only had just like under 10 shares, as you can see. And if we fast forward to today, a year and a half later, I have now just over 100 shares. Quite a difference, guys. And at this point in time, AT&T is bringing in $112 for me in annual dividend income, as you can see on the right-hand side of the screenshot. And as far as my overall portfolio goes, AT&T makes up about 5.4%. So it's quite a chunk of my overall portfolio's allocation. Now, this probably goes without saying, but AT&T is one of those companies that you either love it or you hate it. And I know a lot of investors are kind of skeptical to invest in AT&T right now because the company has made some bad moves in the past in terms of acquisitions and just how the company has been managed overall, which is totally understandable. Me personally, guys, there are a few reasons I'm still rocking with this company. The first of which is because they are one of the top 2 biggest telecom companies in the United States. I'd say it's between them, Verizon, and probably T-Mobile in third. And honestly, I don't see this changing anytime soon. It takes a substantial amount of capital to get a business like this up and running and to build out all of the infrastructure, especially as the world moves into more 5G connectivity and looks for faster internet through high-speed fiber, which AT&T is already providing for millions of customers and anticipates to service millions more in the coming years, which is awesome. But anyway, the high cost to get some skin in the telecom game helps to keep new competition from entering the market, which only helps AT&T retain its dominance in this industry. Anyway, if you keep your ear to the ground and stay up to date with things going on in the world of dividend stock investing, you'll know that AT&T has recently gone through some pretty substantial changes. And as a result of that, namely the spinoff of Warner Media with Discovery, AT&T saw a reduction in the dividend, which is unideal. But despite this, AT&T is still looking pretty solid as far as the dividend stats goes. As you guys can see, the forward dividend yield is extremely high, 5.74%. The payout ratio is not too bad either, 55%. And then because they just reduced the dividend, we're not seeing any 5-year growth rate or consecutive years of dividend growth. But looking at this screenshot now, we can see that prior to the spinoff, AT&T's dividend was looking pretty sweet. And still to this day, they have 37 years of uninterrupted dividend payments. So the dividend is still very consistent. And for most of those years, they were growing the dividend. I believe prior to the spinoff, AT&T was a dividend aristocrat. Anyway, as far as my position goes, guys, I probably won't be adding any more to AT&T right now because it's already a pretty sizable portion of my portfolio. And I want to see what this company does in the next handful of months, moving forward from the spinoff. So I'm still holding the company. I like the direction AT&T is headed. I just hope that they don't screw it up. They have a lot riding on these next few months, or really these next few years as far as I'm concerned. Anyway, moving on to the 4th biggest position in my portfolio. This is one of my favorite dividend stocks, guys. The 4th biggest position I have is StarBucks, ticker symbol SBUX. And like AT&T, Starbucks was one of the very first stocks that I ever bought for my dividend stock portfolio. It was a no-brainer because I'm a really frequent Starbucks customer, so I was like, I got to add this to my portfolio. But anyway, as far as my position goes, guys, I currently have 26.2 shares of Starbucks, and my position is quite down, as you can see there in the middle of the screenshot. I'm down about 15.5%, but still this company is bringing in nearly $50 in annual dividend income for me. So I'm happy there, and I'm looking forward to keep building out this position. But so far, guys, Starbucks makes up 5.75% of my total portfolio allocation. Now, I kind of touched on this a second ago, but one of the big reasons I'm so heavily invested invested in Starbucks is because I just love the company. Okay, I'm a frequent customer at Starbucks, and that's been the case for years, guys. I remember going there as a kid, after church on Sundays or, heading out of town on a road trip, we'd stop at Starbucks. And as a kid, I would always get a decaf peppermint frappuccino, and I'd always have to get a croissant with that as well. I just remember it being one of my favorite things, and it still is. I honestly still love those croissants and get them more often than not when I go to Starbucks. Although nowadays I have upgraded from the frappuccino to the latte, so I think I'm taking steps forward there. But at any rate, guys, all this is to say the Starbucks experience is very special to me, and I know I'm not alone in that, which is why I think it makes for a really good investment. And on that note, as an investment, I think Starbucks has a lot to offer. If you guys checked out my last video, I dove in deep to Starbucks with my good friend Russ from Dapper Dividends. I'd highly recommend you check that video out. But taking a quick look at some of the financial metrics, we're seeing pretty steady revenue growth from Starbucks, which is anticipated to continue into the future, as well as a few years of consistent share repurchases, which is one way that a company can create value for shareholders, in addition to things like share price appreciation and dividend payments, which brings us to the next point. Let's get into this company's dividend stats. They're pretty sweet. As you can see, Starbucks has a forward dividend yield of 2.64%, which is pretty average as far as dividend yields go. The payout ratio isn't showing up today for some reason. I'm not exactly sure why, but it's nothing too out of control from what I remember. But the 5-year growth rate here is where Starbucks really shines. This is a very high growth dividend company with a dividend growth rate of 15.87%. It's definitely one of the highest in my portfolio, which is one of the reasons I'm loading up on this stock so much right now, is because I'm going after that high dividend growth. And they have a pretty respectable dividend growth history as well of 11 consecutive years. Now, I have been loading the boat on Starbucks, guys. It is down quite a bit year to date, as you can see from this chart here. And I'm going to continue stocking up shares because number one, it's one of my favorite companies. And number two, it's at a really nice discount right now. And it is heading even farther south as the days go on. So I am just, like I said, loading the boat on Starbucks. All right, guys, now moving on to the third biggest holding in my dividend stock portfolio. That one is Chevron, ticker symbol CVX. And I will say the biggest reason that Chevron is in the top 5 today is because it has just climbed so much in share price. It is really appreciated. As you guys can see, year to date, just in the last, 4 months, it's climbed 41.17%. And just in the last week, in the last 5 days, it is up another 7%. So this stock is really moving. Now, as far as my position goes, guys, I have 13.15 shares of Chevron. And so far, it's bringing in like $70 in annual dividend income for me. So that's pretty solid. And Chevron makes up 5.93% of my total portfolio allocation. So it's nearly 6% of my total portfolio. Anyway, guys, moving on, within the energy sector, there are upstream, midstream, and downstream energy companies. And Chevron is both an upstream and a downstream company, which I'll expand on a little bit. Now, upstream energy companies are responsible for the exploration and the production of the resources required to make gasoline and other oil-based products. And as that pertains to Chevron specifically, Chevron actually drills for the oil in the oil fields and also out in the ocean and places where they can find oil. And from there, they produce the final product, which could be things like the gasoline we buy at the pump, which brings us to the downstream component. As a downstream company, Chevron maintains and operates different gas stations all across the country, which is undoubtedly what most people know them for. I mean, personally, guys, I go to Chevron all the time for gas. That is my go-to gas station of choice. And that's one of the reasons I decided to invest in this company over some of its other competitors like ExxonMobil or Royal Dutch Shell. And as far as Chevron's dividend stats goes, you guys can see that it has a forward dividend yield of 3.5%, which is kind of low for where this company usually sits, but that's because the share price has run up so much. Anyway, moving on, the payout ratio is 51.37%, which is really not too shabby. Okay, the rule of thumb that I like to use is below 60% for a company like this, so it does meet that criteria. And then the 5-year growth rate is 4.82%, which is also pretty average. Okay, it's at least not beating inflation, and in terms of that, I've actually made some calls, put my feelers out there to see who I can talk to about this inflation thing, because I'd love to get that down to a respectable level. It's just getting wild. But anyway, now moving on to my portfolio's second biggest holding. This one is coming from Altria Group, ticker symbol MO. Now, like Chevron, Altria Group has appreciated for me quite a bit, guys. My position is doing really well. Right now, I have 44.25 5 shares, basically 44 and a quarter share, and I'm up nearly 32% with this position, so not doing too bad. Altria Group is one of my biggest income generating stocks. Right now, it is bringing in over $155 in annual dividend income for me. And as far as its allocation in my portfolio, Altria Group is a whopping 6.8%. So it is a pretty hefty chunk of my portfolio. Now, in case you're unfamiliar with Altria Group, they are what we refer to as a sin stock. And what I mean by that is they make products that aren't necessarily the best for people to consume. These are going to be things like cigarettes, cigars, chewing tobacco, as well as things like beer and wine. They even have their hand in a little bit of cannabis. And some of the brands under their umbrella include some pretty popular ones like Marlboro, Black and Mild, Copenhagen, Skoal, and they even have a stake in Anheuser-Busch, which gives them exposure to some of the top brands in the alcohol industry. Now, as far as the dividend stats go, I've said this before in other videos, Altria Group is a triple threat, okay? They've got the high yield, as you can see, currently sitting at 6.49%. They've got a respectable 5-year growth rate, pretty decent, 8.25%, and they have a dividend growth history of 14 consecutive years, according to Seeking Alpha. But I actually believe this is mistaken. Altria Group is a dividend king, so that's what I mean by triple threat. They've got the yield, they've got the growth, and they've got the growth history. And to expand on this whole dividend king thing, just take a look at this chart right here. We're seeing a steady, very steady trend upward for a long period of time from Altria Group. This chart shows us all the way back to 1990. And I personally haven't picked up any shares of Altria Group for a while. I actually don't think it's a terrible buy right now. I think there are better opportunities on the market, especially in my portfolio. Anyway, guys, moving on to the last stock of the day, the biggest position in my dividend stock portfolio. This is none other than Realty Income, ticker symbol O, aka the monthly dividend income company. Realty Income takes their dividend very seriously, which we'll talk about more in just a moment, but they have even gone so far as to make this a registered trademark for them, the monthly dividend income company. And as far as my position goes, I have just under 37 shares of Realty Income, and right now it is bringing in just over $100 in annual dividend income for me, so that's awesome. Love to see those triple digits, and as far as its allocation in my overall portfolio, it makes up 6.81%, so just under 7%. Honestly, having Realty Income as my biggest position is kind of bittersweet. It's good in the sense that I think it's a really great company, and I'm certainly happy to own it, but then again, if you look at it from a tax perspective, it is not the most ideal because Realty Income pays what are called ordinary dividends, which are different from dividends that you would receive from a normal company like Coca-Cola or Procter & Gamble or Microsoft, who pay qualified dividends. And the difference here is how they are taxed. Ordinary dividends from companies like Realty Income are taxed at a higher rate than qualified dividends, which are coming from those other companies we just mentioned. And the reason for this is because Realty Income is what is called a real estate investment trust, or a REIT. And in case you've never heard of a real estate investment trust, it is just a type of company that owns income producing real estate. Usually it's commercial properties, and they make their money just by collecting rents from their tenants, some of which include some really big companies like Walgreens. Some other tenants they have are Dollar General, 7-Eleven, Dollar Tree, FedEx, LA Fitness, which is a big line of gyms, BJ's Wholesale Club, which from what I've heard is like a Costco or a Sam's Club, CVS Pharmacy, Walmart, AMC Theaters, and the list goes on and on, guys. So they lease their buildings out to some really big companies, and it's safe to say that this is working out for them so far. As far as the dividend stats go, they have a forward dividend yield of 4.38%, which is definitely on the higher end. I'm happy to see that. They have a payout ratio here, which is 302.66%. In general, guys, real estate investment trusts have to pay out 90% of their income to us as shareholders in the form of dividends to receive the tax benefits that they do from being a real estate investment trust. So that's why we see higher payout ratios from these type of companies. And moving on to the 5-year growth rate, this is sitting at 3.71%, which is low. Okay, it's low, but we're seeing a high dividend yield, so I guess there is a trade-off there. Although the growth rate is slow, it still does exist and has done so for some time. The dividend growth history is 25 consecutive years, making Realty Income a dividend aristocrat. And sticking to the topic of the dividend, just sharing a few fun facts, Realty Income has paid their dividends out for 621 consecutive months since their founding in 1969. That's pretty insane. Furthermore, they've increased the dividend 115 different times, and the company has seen 98 consecutive quarterly dividend increases. And from the beginning, from the very start of the company, the dividend has grown over 229%. So that's pretty nice. All in all, if you're a dividend investor, Realty Income, I think, is a good one to have in your portfolio. As far as its price today, I don't know exactly about that. And also, don't make the same mistake that I did and have this be a huge chunk of your taxable brokerage account. Real estate investment trusts like this are much better held in a tax advantage account like a Roth IRA. If you want to keep the party going, then click on this video right up over here. And at this point, guys, I'm putting out 2 videos every single week on the topic of dividend stocks. So if you want to see more from me and follow along, hit the subscribe button here as well. And with that, I will get out of your hair. But thank you so much for watching. I really appreciate it. Hope you guys have a great day, and I'll see you in the next one.